Governor Waller, let's start, I think, having this opportunity to hear your views for the first time. Let's start at the very beginning. What's your view of where we are in this recovery from the pandemic and where the U.S. economy is going?
Well, Steve, I think the economy is ready to rip. We're looking at growth forecast of nearly 8% for Q2. My forecast is about 6.5% for the year. I see unemployment falling to the low fives by the end of the year, and inflation running about 2.5% for the year. So I think the economy is really ready to go. The vaccine program has done amazingly well. There's still more to do on that, but I think everybody's getting a lot more comfortable with having the virus under control, and we're starting to see it in the form of economic activity.
When you look at the character of the economic activity right now, do you see us going through a sugar high right now that is essentially based upon the huge amount of fiscal stimulus coming through, or are we on the verge of what you would call sustained growth?
Yeah, no, I think it's more on the sustained growth. You're going to see some, surge in demand from the stimulus. You're going to see it from the pent-up savings, just the desire to get out of your house and go do things you haven't been able to do for a year. So you're going to see that, a bigger surge. But I think the fundamentals of the economy are, we can get the virus pretty much under control. We get, 70% of the population vaccinated. Then all the fundamentals are there for good, strong growth that we left back in January, February of 2020 last year.
So getting back to the familiarity here, Chris, you and I have both been following Fed policy for a very long time. And you have to admit, given that outlook you just gave, it would be normal for a Federal Reserve official such as yourself to be talking about constraining what is easily the most wide open policy that you and I can ever remember. Is that what you're thinking? Is it time to put the brakes on here, given that you just said, I think we have up there on the screen, that the economy's about to rip?
Yeah, I mean, the thing is, we have to keep in mind that from the level of where we were, we're not there yet. So we've still got room to catch up where we were. We're making up for lost ground. So just because the growth rates are really good and everything's looking like we're heading off in the right direction, we're still trying to make up a lot of ground. As Chair Powell has said, we're still down somewhere in the neighborhood of 8 million jobs from where we were just a little over a year ago. So we've got to make that up first. Other parts of the economy seem to have already come back, but we still have relatively high unemployment rates, particularly for minorities. And so we've still got a long way to go. There's no reason to be pulling the plug on our support until we're really through this.
One of the potential downside here that we hear has a lot of getting a lot of concern out there is the issue of inflation. And let me just give you some of the data from this morning, Governor Waller, that I bet you've seen. The University of Michigan one-year expectations for inflation of 3.7%, the highest since 2015. The 5-year at 2.7 is just one tick off the high since 2015. Are you a subscriber to this idea that inflation that may be coming will be temporary? And how can you be so sure?
Yeah, I am. I do buy into the idea that this is going to be temporary. We know there's a bunch of reasons for this. One is just the base effects. We're coming off very low readings. Everybody forgets that service prices drop something like 6%. So they can come up 6%, and you're just back to where you were last March. So you can't, again, you just can't look at the growth rate. You got to look at the levels where you're at. We know this stimulus is going to have some impact, but once the stimulus checks are spent, they're gone. Once the pent-up savings is spent, it's gone. There's no further demand, excess demand coming out of those things. We also know the bottlenecks that are currently there are going to go away. Firms are going to get capacity up and running again. So whatever temporary surge in inflation we see right now is not going to last. And I think if you look at as you said, 5 years, they're still around the 2.5%. They haven't really taken off. They're about where we would think is reasonable. And these are people that have money on the line. So they're not betting on outrageous runaway inflation, or we'd see it in their pricing of tips.
Shepard Smith here. Thanks for watching CNBC on YouTube.